Understanding inflation data, a comprehensive overview. Inflation is a critical economic indicator that measures the rate at which prices of goods and services rise over time. It affects every aspect of our lives, from the cost of groceries to the price of housing and healthcare. In this article, we will delve into the concept of inflation, its causes and effects, and the significance of analyzing inflation data for individuals, businesses, and policymakers. So let's embark on this informative journey to better understand inflation and its impact on the economy. Introduction. Inflation is an economic phenomenon that affects the purchasing power of currency. It is crucial to comprehend its causes, effects, and implications to make informed decisions in personal finance, business, and policymaking. This article aims to provide a comprehensive overview of inflation, focusing on its definition, measurement methods, causes, effects, and the importance of analyzing inflation data. What is inflation? Inflation refers to the sustained increase in the general price level of goods and services in an economy over a specific period. When inflation occurs, each unit of currency buys fewer goods and services than before. It is often expressed as a percentage and measured annually. Measuring inflation. Consumer Price Index, TP. The Consumer Price Index, EPO, is one of the most commonly used measures to gauge inflation. It tracks changes in the prices of a basket of goods and services typically consumed by households. By monitoring the CPI, economists and policymakers can assess the cost of living and adjust economic policies accordingly. Producer Price Index, P. The Producer Price Index, PI, is another essential tool to measure inflation. Unlike the CPI, which focuses on consumer goods, the PI tracks price changes in goods and services at the wholesale or producer level. It helps analyze inflationary pressures along the supply chain and can provide insights into future consumer price movements. Causes of inflation. Inflation can stem from various factors, including demand, pull inflation, and cost. Push inflation. Demand, pull inflation. Demand. Pull inflation occurs when aggregate demand for goods and services surpasses the economy's ability to produce them. It often happens during periods of robust economic growth, increased consumer spending, or excessive government spending. When demand exceeds supply, businesses can raise prices, leading to inflationary pressure. Cost, push inflation. Cost, push inflation, on the other hand, arises from increased production costs. Factors such as rising wages, higher raw material prices, or increased taxes can lead to higher production expenses. To compensate for these costs, businesses may increase the prices of their products or services, causing inflation. Effects of inflation. Inflation has significant implications for individuals, businesses, and the overall economy. Purchasing power erosion. One of the primary effects of inflation is the erosion of purchasing power. As prices rise, the same amount of money can buy fewer goods and services. This decrease in purchasing power affects consumers' ability to maintain their standard of living, especially for those on fixed incomes or with limited resources. Redistribution of income and wealth. Inflation can also lead to a redistribution of income and wealth within society. Debtors benefit from inflation as the value of their debt decreases over time, while savers and creditors experience a decline in the real value of their assets. This redistribution can have social and economic implications, affecting wealth inequality and financial stability. Uncertainty and economic instability. High inflation rates can create economic uncertainty and instability. Businesses may struggle to plan for the future and make informed investment decisions as the value of money becomes less predictable. Additionally, inflation can lead to wage price spirals, where workers demand higher wages to keep up with rising prices, further fueling inflationary pressures. The importance of inflation data. Accurate and timely inflation data is crucial for various stakeholders, including individuals, businesses, and policymakers. It provides valuable insights into the state of the economy and helps inform decision-making. Inflation data allows individuals to gauge the impact of rising prices on their personal finances. It helps them adjust their budgets, make informed purchasing decisions, and plan for future expenses. By monitoring inflation rates, individuals can protect their savings and investments from the erosive effects of inflation. For businesses, analyzing inflation data is essential for pricing strategies, production planning, and managing costs. By understanding the inflationary environment, businesses can make informed decisions regarding price adjustments, negotiate contracts, and plan for potential risks. Inflation data also provides insights into consumer behavior and demand patterns, enabling businesses to adapt their strategies accordingly. Policymakers heavily rely on inflation data to formulate and evaluate economic policies. Central banks use inflation data to set interest rates, control monetary supply, and maintain price stability. Governments consider inflation when formulating fiscal policies, such as taxation and public spending, to manage inflationary pressures and promote economic growth. Analyzing inflation data. To make sense of inflation data, analysts employ various techniques and indicators. Inflation rate calculation. The inflation rate is calculated by comparing the current price level to a specific base year. It is typically expressed as a percentage. Economists and statisticians use mathematical formulas to aggregate price changes across various goods and services and derive a single inflation rate. Core inflation vs. Headline inflation. When analyzing inflation data, it is important to distinguish between core inflation and headline inflation. Core inflation excludes volatile components such as food and energy prices, providing a more stable measure of underlying inflationary trends. Headline inflation, on the other hand, includes all price changes across the economy. Both measures provide valuable insights into different aspects of inflationary pressures. Inflation's impact on different sectors. Inflation can have varying effects on different sectors of the economy, such as financial markets, businesses, and government policies. Financial markets. Inflation has a significant impact on financial markets. Investors closely monitor inflation data as it affects interest rates, bond yields, and stock market performance. Rising inflation can lead to higher interest rates, which can impact borrowing costs for businesses and individuals. It can also influence investment decisions as investors seek assets that can provide returns that outpace inflation. Business and investments. Businesses need to carefully consider inflation when planning their operations and making investment decisions. Inflation can increase production costs, affecting profitability and pricing strategies. Companies may need to adjust their pricing models to maintain profitability in an inflationary environment. Additionally, businesses may need to invest in inflation, hedging assets, or adjust their supply chains to manage the impact of rising costs. Government policies. Inflation plays a crucial role in shaping government policies. Central banks use inflation data to determine monetary policy, including setting interest rates and adjusting money supply. Governments consider inflation when formulating fiscal policies, such as taxation and spending, to manage inflationary pressures and promote economic stability. Inflation data also influence policies related to wages, Social Security benefits, and pension plans. Coping with inflation. Managing inflation requires individuals and businesses to employ strategies that mitigate its impact. Adjusting wages and salaries. During periods of inflation, individuals may need to negotiate higher wages or seek employment opportunities that offer better compensation. Businesses should consider adjusting employee salaries to keep up with rising living costs. This helps maintain the purchasing power of individuals and contributes to overall economic stability. Investing in inflation. Protected assets. Investors can protect their wealth from inflation by diversifying their investment portfolios. Investing in assets such as inflation, protected securities, real estate, commodities, or equities can provide a hedge against inflation. These assets tend to perform well during inflationary periods and can help preserve the value of investments. Central bank intervention. Central banks play a vital role in managing inflation through monetary policy. By adjusting interest rates and controlling the money supply, central banks aim to maintain price stability and manage inflationary pressures. Their actions influence borrowing costs, investment decisions, and overall economic activity. Future trends and predictions. Forecasting future inflation trends is a complex task influenced by numerous economic factors. Analysts and economists use historical data, economic indicators, and predictive models to make projections. Factors such as global economic conditions, government policies, and supply-demand dynamics can impact future inflation rates. Regular analysis of inflation data and economic trends can help identify potential future scenarios. Conclusion. Inflation is an essential economic concept with far-reaching effects on individuals, businesses, and governments. Understanding inflation and analyzing inflation data is crucial for making informed financial decisions, managing risks, and formulating effective economic policies. By monitoring inflation rates and its impact on various sectors, stakeholders can navigate the challenges and opportunities presented by inflationary environments. Frequently asked question: what is hyperinflation? Hyperinflation refers to extremely high and typically accelerating inflation. It occurs when inflation rates spiral out of control, eroding the value of the currency rapidly. Hyperinflation can have severe consequences, including economic instability, social unrest, and the collapse of financial systems. How does inflation impact housing prices? Inflation can influence housing prices. As the cost of construction materials, labor, and land increases, developers and homeowners may pass on these costs to buyers, leading to higher housing prices. Inflation can also impact mortgage interest rates, affecting affordability for potential homeowners. What are the tools used by central banks to control inflation? Central banks have several tools at their disposal to control inflation. Some of the key tools include interest rate policy. Central banks can raise or lower interest rates to influence borrowing costs. Increasing interest rates can discourage borrowing and spending, which can help curb inflationary pressures. Conversely, lowering interest rates can stimulate borrowing and spending, promoting economic growth. Open market operations. Central banks can buy or sell government securities in the open market to influence the money supply. By purchasing securities, they inject money into the economy, increasing liquidity and potentially stimulating economic activity. Conversely, selling securities reduces the money supply, which can help rein in inflation. Reserve requirements. Central banks can require commercial banks to hold a certain percentage of their deposits as reserves. By adjusting reserve requirements, central banks can influence the amount of money that banks can lend, thereby affecting the overall money supply and inflation. Forward guidance. Central banks provide guidance on future monetary policy actions, signaling their intentions to the market. This communication can help manage inflation expectations and influence consumer and business behavior. Quantitative easing. In times of severe economic downturn or deflationary pressures, central banks may implement quantitative easing. This involves purchasing government bonds or other financial assets to inject money directly into the economy, stimulating lending and economic activity. Inflation targeting. Many central banks have adopted inflation targeting as a framework for conducting monetary policy. Inflation targeting involves setting a specific inflation target and adjusting policy instruments to achieve that target over the medium term. It is important to note that the effectiveness of these tools can vary depending on the economic conditions and the specific circumstances of each country. What is hyperinflation? Hyperinflation refers to extremely high and typically accelerating inflation. It occurs when the inflation rate reaches excessive levels, often exceeding 50s per month. Hyperinflation erodes the value of the currency rapidly, leading to a loss of confidence in the monetary system and causing economic instability. How does inflation affect the average consumer? Inflation can impact consumers in several ways. As prices rise, the cost of living increases, reducing the purchasing power of consumers. This means that individuals may need to spend more money to maintain the same standard of living. Inflation can also affect interest rates, making borrowing more expensive and potentially impacting mortgage rates, credit card interest rates, and other loans. Is inflation always bad for the economy? Inflation is not necessarily always bad for the economy. A moderate level of inflation within a target range set by central banks is generally considered healthy for economic growth. It encourages spending, stimulates investment, and can help reduce the burden of debt. However, high or unpredictable inflation can create economic instability, erode purchasing power, and hinder long-term economic planning. Can inflation be completely eliminated? Completely eliminating inflation is challenging as it is influenced by various factors such as supply and demand dynamics, government policies, and global economic conditions. Central banks aim to maintain price stability by keeping inflation within a target range. However, eradicating inflation entirely may not be feasible.